Hey everyone, Santa Brustine here from the Venture Analyst, and today we'll be breaking down Canadian real estate. We'll be looking at the full picture because the reality is actually much more interesting than the headlines you see. So Canadian real estate is not one market, it was never one market, and right now in March 2026, that divergence is more extreme than it's ever been. Actually. There are cities in this country that just hit all-time highs, and there are some cities in the country with the worst correction in generations. At the same time in the same country. So today I'm going to break it all down for you. The national numbers, the condo crisis, the rental reversal that nobody saw coming. The REITs, real estate investment trusts, which are mispriced, and which ones to avoid, and one specific name that I think is genuinely interesting right now. The regional divergence, and what I think is going to happen from here. I'm also going to spend time with some senior housing story because I think it's the most compelling real estate investment thesis in Canada right now, and almost nobody in retail finance is talking about it. This is going to be a long one, get comfortable, and let's go. So we'll start with the national snapshot. We'll anchor the conversation with the actual data first. So in January 2026, the most recent month, the national benchmark of home price is $658,300. That is down 4.9% year over year, and monthly sales were 36,186 on a seasonal adjusted basis. This is down 12.5% from January 2025. New listings were up 7.3% month over month, and the national sales to new listing ratio is sitting at 45%, which is technically balanced market territory. Here's what the national number hides though. Quebec just hit an all-time high benchmark price of $535,000. Montreal is up 5.5% year over year. Meanwhile, Ontario is down 6.4% year over year. BC is down 1.9% year over year. And the GTA average home is down 8.1%. These are not small variations. This is some real noise. These are two completely different economies happening right in the same country at the same time. So the CREA's full year 2026 forecast is 494,000 homes sold nationally. This is up about 5% from last year, and the national average price up 2.8% to around 699,000 by the year end. This is the base case. It's not exciting, not catastrophic. This is just slow grinding normalization. But the story under the headline is way more interesting, and let me break it down for you. So let me go over the macro forces happening right now. There are 5 macro forces that are driving everything happening in the market right now. First, you need to understand all 5 for any individual story makes sense. So we have first the rate hold. The Bank of Canada is at 2.25%, unlike 2024 and 25, where we had an active cutting cycle. The signal right now is we're done. Most major bank and economists expect rates to stay here for most of 2026. No more cuts, no hikes, just stable. And the stability cuts both ways. It removes the urgency argument for buyers, but also removes the fear of further rate shock. For the market, it's roughly neutral. Second, we have the trade war. US tariffs are what I would call a slow-moving negative. CMHC's very own official housing market outlook, published this year, literally says in their words, the business sentiment worsens, the government projects are delayed. Canada is slipped to a mild recession in 2026. That is their base case document, not a tail risk. It's a status scenario. Third, this one I will spend the most time on, is the immigration reversal. For the last decade, immigration was the biggest structural driver in Canada housing demand. New arrivals need a place to live. They rent first, they buy. The pipeline was enormous. The federal government set a permanent resident target of 485,000 per year. They just slashed that to 365,000. And a net temporary resident international student foreign workers actually declined in 2025. Population growth in BC was eventually negative for the part of the year. That demand floor has been substantially removed deliberately. So fourth, the mortgage renewal wall. I'm going to come back to this what I'm watching section because it deserves real attention. The short version, massive volumes of 5-year fixed mortgage from 2021 rates at 1.5 to 22.5% are renewing this year at 4.5 to 5.5%. That monthly payment shock for some homeowners is $600 to $900 a month. On typical Toronto mortgage, that's real money. Fifth, and here's the counterbalancing bull argument. So pent up demand per capita home sales in 2020 in Ontario are up to 25% below long-term historical averages right now. That's years of buyers sitting on the sidelines with money, waiting for certainty. The Bank of Canada saying rates are as good as they're going to get in October was potential dash signal. The coil is wound. The question is just what unwinds it. Now let's talk about the Toronto condo crisis. because this is a genuine crisis. I don't think the broader public understands how bad this data actually is right now. In 2026, 85 new condominium units were sold across the entire Greater Toronto area. 85 in a metro area of 7 million people is not around a year. That is according to Abide and Altus Group data, the authoritative source for this new home sales in GTA. And for context, the market was moving thousands of units per month in 2021 and 2022. The 10-year historical monthly average is somewhere between 770 units. We posted 89% below that. For the overall GTA new home sale figure, all home types combined was 5,314 units for this year, the lowest in 40 years of data tracking. Let me repeat that, 40 years. The market has been this low since the 1980s. How do we get here? That is actually a pretty clean story if you trace it. Aggressive rate hikes from 2022-23 more than doubled borrowing costs. Pre-construction investors who bought more than half of the condo units being built, largely as rental plays, watched the math fall apart. Rising rents made carrying the cost on pre-construction condo exceeded what the rental market would bear. They couldn't sell at acceptable prices and they couldn't rent profitably. Many are just stuck. Then immigration also got cut, which removed the rental demand, which was the last backstop for the whole investor thesis. And then the construction started collapsing in response. Only 2 new condo projects launched in Q1 2025, 2 in the biggest city in Canada, compared to 69 launches in 2023. Active development projects dropped from 206 to 135, and construction employment in the sector was down over 35,000 jobs. So the average GTA condo price is at $542,500, almost down 10% year over year. The average Toronto home overall is $936,100, down 8.1%. The GTA sales to new listing ratio is 29%, which is a deep buyer's market, and it's been there for months. Now let's go over the supply cliff, as you see below. So here's the part of the Toronto condo story that almost nobody's talking about because everyone is focused on how bad things are today. And today is bad, but the crisis today is creating condition for a shortage tomorrow. Look at the completion projects 2025. The GTA will see roughly 31,000 condo completions, the peak of the pandemic pipeline hitting the market all at once. That's what's driving the oversupply. By 2026 end is projected around 17,000 units. 2027 drops to maybe 11,000. 2028 could see below 9,000. Think about what that means. No new projects are launching today, zero pipeline being built, and completions are falling off a cliff. If immigration policy reverses, even partially, if population growth returns, if the pent-up buyers' demand finally unlocks, you've got a severe supply shortage arriving at the worst time possible, by 2027 or 2028. The CEO of True North Mortgage, one of the sharper minds in Canadian mortgage industry, said it directly. The specific segment to watch in quality condos, 750 square foot and larger, is when investors move first when the sense bottom. Those are the apartments where people want to live in. When you start seeing absorption improve in that specific cohort, you see the broader condo market is turning. I'm not calling bottom today. No credible analysts calling bottom today, but the seeds of the next supply crunch are being planted right now. Though in action, and that has historically been one of the better times to think about positioning. Now let's go over the rental market reversal. So the rental market story just genuinely surprised me when I was building this video because for years, literally years, the Canadian rental narrative was rents are only going up, vacancies near zero, and landlords have all the power. That story is no longer true. For the first time since the pandemic recovery, Canadian rents are broadly dropping. Statistics Canada confirmed the structural transition is underway. National average asking rent January 2026 was $2,057 a month, down 2% year over year. Toronto 2-bedroom average is now $2,100 at $2,300, down 4%. Vancouver is down 6% year over year, 5.9% to be specific. National vacancy is at 3.1%, the highest it's been in years. 4 things hit simultaneously to cause this. First, record supply, more than 148,000 now dwelling were completed in Canada's major metros in the first 3 quarters of 2025. Over 64,000 of those were purpose-built rentals, all hitting the market at the same time. Second, we have immigration reversal. I mentioned these before. It hits the rental market the hardest. Canada lost 290,000 non-permanent residents in 2025. Immigration overall was down 80% year over year. Non-permanent residents were the fastest growing renter group for decades straight, and then demand floor just dropped sharply. Third, we have investors flooding in the shadow supply. You can't sell your condo, you're renting it instead. Thousands of units were not previously in the rental pool are now competing for tenants. And fourth, Vancouver specifically, CMHC confirmed Vancouver hit its highest rental vacancy in 30 years. BC posted negative net population growth, and the market used to have 0.5% vacancies, now sitting at above 3%. The important caveat here is not national. The prairies are a different story. Saskatoon rents are up 6% year over year, Winnipeg up 4.5%, and the two-speed Canada is nowhere more visible than the rental market right now. And this rental softness has a shelf life. The supply cliff means the vacancy store right now flips again when completion drops and demand eventually recovers. But for now, if you're a renter in Toronto or Vancouver, you have more negotiating power than you've had in years. Okay, so real estate investment trust is where I want to spend real time because this is the investor lens on everything I've just described. The framework here is simple. What does the underlying property type actually do when the economy slows or contracts? The answer to that question tells you what real estate investment trust categories deserve attention. Let me go through the 6 main Canadian REIT sectors. Okay, so we have senior housing, which is a strong buy in my opinion. CHC and .UN and SIA.TO are the leading companies. This is the cleanest real estate investment store in Canada right now, and I want to be direct about that. Not one of the better ones, the cleanest. Let me explain why. The baby boomers turn 80 in 2026. That's not a forecast, that's arithmetic. Statistic Canada projects Canada's 80 and overpopulation growing at 4.8% per year through 2036. You cannot interest rate hike your way into demographic wave. You cannot tariff it, you cannot immigration policy, it just happens. Meanwhile, supply is structurally broken. Only 1% of existing senior housing stock is built annually. Half of the Canada's existing supply is aging out and needs to be replaced by redeveloped CBRE's National Seniors Housing Lead, Stefan Hiscox, said that this was a direct quote I read. We're now staring straight at the face and it's here. So let's go over CSH.UN, also known as Chartwell. Dropped 680 million in acquisition in 2025 alone. Sienna made 880 million memory care acquisition, targeting the highest acuity, highest margin residents. Chartwell was up 62% in 2025, and it was the best performing real estate investment trust category in Canada by a wide margin. And the demographic tailwind accelerates from here. National seniors housing occupancy is projected towards 95% in 2026, the highest NOI growth in any real estate category in Canada. RBC has a $20 target on Chartwell, CIBC has 23. As for industrial, we have DIR.UN and GRT.UN. While the market falls apart and condo markets cater, industrial and logistic real estate in Canada is quite excellent. Sub 5% vacancy nationally, e-commerce structural demand, and here's the interesting angle. Under tariff environment, near shooting. So if companies are pulling supply chains back from the US or shuffling to avoid tariff exposure, they need a Canadian redistribution space. Tariffs are the headwind for the broader economy and are a direct headwind for industrial real estate investment trust demand. Now let's go over grocery anchored retail. Some companies, leading companies, CRR.UN and CHP.UN. This is selective buy because I want to be very specific, the selective here. General retail, I wouldn't touch. Mall real estate investment trust, discretionary anchored centers, not interested. What I'm talking about is the grocery and pharmacy anchored retail. Loblaw anchored, Walmart anchored, Shoppers anchored. These tenants don't close. RioCan's grocery anchored portfolio is 97% occupied. CT real estate investment trust is 99% occupied. In potential recession, these occupancy rates don't move, and both traded at a discount to NAV, and I think this is justified. NAV is in net asset value. As for residential and apartment selective, we have CAR.UN, MRG.UN, BEI.UN. This is the nuanced one. Near-term headwinds is real, vacancy rising, rent softening, but the NAV discounts have opened up generally specific, and I want to call out one specific name. So here we have Morguard National Residential, MRG.UN. This has 13,089 residential suites across Canada and 9 US states. Their portfolio was appraised at 4.3 billion Canadian. The current market cap is 1.35 billion. You're buying $1 for 32 cents. All three covering analysts rated to buy. Average price target is 22.25 versus the current price of 18.49. And you get a 3.5% annual yield, dividend yield to wait. That NAV discount has existed here for years because real estate investment trust is underfollowed and lower profile. Patient capital wins here. Broadwalk is also worth mentioning. So Broadwalk is also worth mentioning. 98% occupancy in Alberta and Saskatchewan, specifically where the rental market is tight. Geography matters enormously because residential real estate investment trusts right now. That's IIP.UN. Now let's go over office, which you should avoid. I'll be direct, avoid this because downtown Toronto office vacancy is still climbing. Work from home is reversing for knowledge workers. Allied properties are down 2/3 from its peak and haven't recovered. The only segment is dormant demand is AAA trophy assets, brand new, premium amenity offices. Everything else is structurally impaired for multi-year periods, and it's not a contrarian opportunity here. Now let's go over the regional divergence. This is the most underreported story in Canada right now, real estate Canadian real estate. The national averages hide an extreme divergence between what's happening on the coast and what's happening in the interior. Toronto and GTA are correcting. I've covered this in length. The condo market is in the worst generations. The broader housing market is the buyer's market with 5.8 months of supply, still elevated prices in absolute terms, but falling onto year-over-year basis consistently. As for British Columbia, it's softening. Vancouver averages 1.21 million, up barely 0.2% year over year. Sales down almost 23% year over year in January 2026. BC was the highest major province with negative population growth in 2025. Vacancy at 30-year highs in rental market, affordability issue and structural, and nobody has solved it. As for Quebec and the plan in Canada, it's resilient. Quebec benchmark hit an all-time high in January 26, $535,000. Montreal's up 5% year over year. Quebec City has a low unemployment, strong demand. Atlantic Canada, Halifax, Moncton, New Brunswick, year over year gains. Student healthcare sector and demand is holding up. And then for the prairies, this is where the real story is. I think it's generally important here. So Saskatchewan specifically leads all the major cities in GDP growth in 2024, and the Conference Board of Canada expects it to do it again. Saskatoon rents are up 6% year over year, the best rental performance of any major market in Canada. Edmonton is projected to be the only major Canadian city that restores pre-pandemic affordability during this correction. Alberta's domestic migration is also firmly positive. And crucially, these are the most affordable major markets in the country. You get value, you get income, you get growth, you get economic momentum. And the reason I think nobody talks about it is because Bay Street in Toronto and everyone else watching the market, they can see from their office window, also known as Toronto. So here's what I'm watching. All right, 5 things I'm watching that will tell me before mainstream narrative does what actually happens in the Canadian real estate is number 1, GTA listing volumes in Q2. Mortgages renewal shock, the 5% fixed mortgage from 2021 at 1.5 to 2.5% are renewing at 4.5 to 5.5% this year. On a typical $700,000 Canadian mortgage, that's $600 to $900 more per month. CMHC flags are explicit. If listing volumes in April, May, and June spiked 15 to 20% above last year's levels, that tells you 4 sellers are materializing. That's the data I've watched most closely in the next 90 days. I would watch. 2, immigration policy signals. This is the biggest demand lever in Canadian housing that has been turned down. And reversal of the immigration tax cuts driven by labor market needs, political pressure, whatever reason, is the most powerful positive catalyst possible for this market. Watch for every policy announcement. This could change the whole picture in 12 months if the government reverses the course. Number 3, quality condo absorption of 700 plus square feet. I mentioned this earlier, but it bears repeating as a monitoring indicator because when absorption starts improving specifically in the quality 750 square feet plus segment, not studio condos, not micro units, you're seeing the beginning of institutional sophisticated investor return to the market. That's a leading indicator of a broader condo recovery. Watch BILD and Altus Group monthly reports. Number 4, we have senior housing occupancy data. If national senior housing occupancy hits and exceeds 95% ahead of schedule, Chartwell and Sienna will be re-rated quickly. Chartwell is the key name. Watch out for quarterly earning reports. The sector is the quiet winner of the next 3 to 5 years, and most retail investors aren't positioned yet. Number 5, we have the Prairie market divergence. If Saskatoon and Calgary keep outperforming while Toronto and Vancouver continue softening, this stops being a cyclical divergence and starts being a structural demographic shift. That has long-term implications where Canadians choose to live, where capital flows, and where the growth markets are. The data has been pointing this way for 2 years. If this continues for another 2, it's not a trend and it's the real deal. Now, let me give you the bottom line. Canadian real estate in 2026 is not a crash, it's not a boom, it's a reset. A painful, uneven, regionally divergent reset that has started in 2022 and is working itself through the system. The Toronto condo market is genuine price right now, and the bottom is not in yet. But the supply cliff is creating, the fact that almost nothing new is being built means people identify quality assets as distressed prices in the next 12 months may look back at a period as one of the better entry points in this generation. Not today necessarily, but we're getting closer. So senior housing is the single cleanest real estate investment story in Canada right now. Baby boomers turning 80 is not a macro call, it's arithmetic. CSH.UN and SIA.to are easiest way to play it, are the best way to play it within public markets. For rentals, power has generally shifted tenants for the first time. The window is probably 18-24 months before the supply cliff and the immigration recovery closes it again. As for the prairies, Saskatchewan, Alberta specifically, the most unreported real estate story in the country. Everyone's watching GTA does, and the better trade might be watching what Saskatoon does. And the mortgage renewal wall is the risk I'd be watching most carefully between now and September. If listing volume spikes in Q2, that's your signal something is breaking. That's the full picture. No spin, no narratives, just the data. If this was useful, subscribe, share with someone you've been thinking about real estate right now. We'll have follow-up content going deeper into specific segments. I'm Yonton, this is TVA, Venture Analyst. See you in the next one.